Good morning. Welcome to the Community Voice. I'm Steve Graddick, your host. Delighted to have you with us on this beautiful morning. And we're very pleased. We do this once a year. It's an annual event, if you will. Dave Pollard is a registered principal at the investment firm of Raymond James. Good morning, Dave.
Good morning.
We're here to
Thank you.
We're here to talk about money and investing and all those wonderful, important things. Before we get started, I haven't done this before, silly kind of question, but who was Raymond James?
Well, gosh, you've caught me off guard with that one. I'm going to have to go back in the history.
Just briefly.
Just briefly. So Raymond James was not one person. It was Tom James and whoever his original partner was. I joined Raymond James in 1996, and even then I joined a subsidiary of Raymond James called Robert Thomas Securities, and over the years, those different subsidiaries under the overarching name of Raymond James have come together to form one company.
Seems like every investment firm has
that's right,
has some sort of name, and some of them have, a superhero individual and some
that's right.
Composite. I want to kind of knock out a couple of simple questions before we get into the market today. Old guys like me are always telling young guys that you need to start investing in the very early years, in your teenage years, because I never did. And that's a whole nother story. But when should someone start investing, or it's a corollary question, are you ever too old to start?
Well, you're never too old to start, and you're never too young to start. We've all been directed to start saving our money, investing our money at a young age, and there is a tremendous amount of capital that can grow from just small amounts invested over time, over a long period of time, with a pretty good rate of return. If you use just a 7 or 8% of return, annual return, and you take someone who's 20 years old, puts $100 a month into a mutual fund, $1,200 a year at, say, 8% return, to what that compounds to by the time they're just 40 years old. And we've all seen the stats where the longer you wait to start that, the harder it is to build net worth, the harder it is to build investment accounts. And that's certainly true, but it's never too late to start, and it's never too early to start.
How do you explain, and I do want to talk about the market today, but along those lines, you're talking about the long-term investing. It seems like the market over the last decade or so has really exploded. Why is that? Why are we seeing these record numbers? And I assume that applies both for the Dow and the NASDAQ too.
Well, there has been the numbers and the return numbers in the market have been higher over the last 20 years compared to the 100-year average. The 100-year rate of return average for real estate and for stocks has been just over 10%. The last 20 years has been a little bit higher than that. I mean, depending on what index that you look at, whether it's NASDAQ or S&P, we have seen a greater return than the 10% long-term average. And there's a whole lot of variables that go into that. Probably the main one is, if you think back over the last 20 years, interest rates have been at all-time lows for our country. And low interest rates is easy money. The more money there is in the system, the more companies are going to earn. The more companies earn, the higher stock prices go. I do remember when I started in the business, I started with Raymond James in 96, but I started in the business in October of 87 when we had a huge market crash in 87. And the market was at somewhere around 500 or 600. And today, the Dow, that was the Dow. Today, the Dow is somewhere around 39,000, almost 40,000. We've been above the 40, but it's pulled back some. I remember I read a book, and I can't even remember the guy's name, but he said that the Dow Jones Industrial Average will be at above 20,000 points by the year 2015 or whatever the date was. And I just remember reading that in the late 80s going, this guy has lost his mind. Well, now it's twice that. But again, if you go back and put a compounded average rate of return on the Dow, it's been somewhere around 12% a year. So it's not outlandish more over the last 20 years as compared to historically. But the numbers themselves make us think, oh, my goodness, how is this sustainable?
I kind of want to keep things simple because I think that's a positive. But give us, what's the difference between the NASDAQ and the Dow?
Well, the Dow is 30 stocks, whereas the NASDAQ is really a trading system. It's a platform for trading, and it represents, thousands of different companies that are traded over that platform.
But I thought they were like top-end companies.
Yeah, they may be. I mean, they're certainly the top 7, NVIDIA and Google and Amazon, they are all traded via the NASDAQ, but there's 1,000 other companies that are traded on the NASDAQ. The Dow Jones Industrial Average is just 30 stocks that they compile the average return for the day.
Okay, let's go ahead and take an early break and get back, and we'll talk about the market today and what we can look forward to. We're also on Facebook Live. If you have any comments or questions, we'll be back with more with Dave Pollard, registered principal at investment firm Raymond James.
Oak Mountain Academy is an innovative school of academic excellence celebrating over 61 years. I'm Patrick Uran, head of school, inviting you to join us on the mountain to see our mission and vision in action. Academic excellence, a faith-based environment, and dynamic opportunities are just a few of the reasons our families choose Oak Mountain Academy. Academic scholarships and tuition assistance are available. For more information, visit us at oakmountain.us. Discover your journey at OMA. Prepare, explore, and achieve.
Health is a journey. It's making better choices, even when it's not easy. It's taking care of yourself and the people you love. At Tanner Health System, we're there for you with every step, with primary care, heart care, cancer care, women's care, orthopedics, surgical services, and so much more. We're dedicated to helping you live and feel your best. So let's get on that journey to health. You've got places to be for many years to come. Find us at tanner.org.
Good morning. Welcome back to the Community Voice. I'm Steve Gradick, your host. Dave Pollard, registered principal at investment firm Raymond James for his annual trek over to Community Voice. Okay, I watched one of your market updates, and you said we were in a sideways market. What in the world does that mean?
Well, basically what that means is that the market goes up and then it goes down. So if you use a time period to mark that, so let's say we started in January and we marked it through this past Friday, or let's go this past Tuesday because of the 4th of July. And let's say that just as an example, the Dow started the year at 39,700, but somewhere in the year it went up to 40,000, and somewhere in that 6-month period, or a little over 6-month period, it went down below the 39, but we end up on at Tuesday at the close at 39,700 point, right where we started. That's basically a sideways market. And we've had, so far this year, if we measure it from where the year started in January, we're the NASDAQ that you mentioned just a minute ago, as a return, is up about 14% year to date. The S&P 500, which is the 500 largest companies that trade in the markets, you didn't mention them, they are up about 10%. The Dow Jones that you mentioned just a minute ago is only up, I think it's about 5%. I haven't looked at it in a minute. But since about April, we've sort of just been in a sideways market. We haven't really made moves up. We haven't really made moves down. Now, not to get too technical, okay? We have seen in the last couple of weeks of trading where both the S&P 500 and the NASDAQ have broken through levels to the upside. And what that means is that we could get a pretty sustained move higher from where we are right now. I know that's getting real technical.
Well, I noticed also in that report you use the term moving averages.
Right.
What is that?
So like we'll use the example of the 50-day moving average. So let's use NVIDIA price. So they'll go back for the past 50 days. What was the closing price of NVIDIA on those 50 days? And then they average those 50 days, and that becomes the moving average. So every day that average is moving. So I mentioned just a minute ago, we're breaking through areas to the upside. So if the 50-day moving average, if we've closed below that and then we start moving above it, that's a positive signal. If the moving average is below where the stock price is and it closes below, that's a negative. So now extrapolate that into an index, 500 stocks. It's got the 50-day moving average. So the index, the S&P 500, has broken through that 50-day moving average to the upside. There's also the 200-day, the 150-day. So when you see the indexes break through those moving averages, that means that there's a lot of stocks participating and that is a strong market. So that gets real technical. So let me straighten that out. Whenever it boils down to this, when stock prices are going up, that's good. When stock prices are going down, you need to pay attention.
You referenced NVIDIA, and that's one of those, I think it's an AI stock, and it's somewhat of a hot stock now. When you read about these type of stocks and you're enticed to invest in those, are there any cautions you would put forward?
Well, certainly the AI stocks, the artificial intelligence stocks, they are having huge effects on the market. It's mostly the chip makers like Advanced Micro Devices, NVIDIA, Intel to a point, Micro Semiconductor, all of those companies that AI is becoming a big part of their business. And so I made this comment to you in one of our past annual meetings that the market and the economy aren't even related. So what the market is looking at is how is AI going to affect the earnings of company in the future. It's not so much how it's going to do it now, it's how it's going to have an effect on companies in the future. And so NVIDIA is sort of the leader in this AI microchip development. And so what the market is rewarding NVIDIA, saying your future sales numbers, your future earnings numbers, we think are going to be massive because of AI. And so people are buying the stock. And so when people start buying, the price of the stock goes up. So to answer that question, is NVIDIA, is it really worth the price that it's trading at right now? Well, I mean, who knows? We'll know in the future if it comes to fruition. It has probably gotten a little bit extended on a price-wise.
In real estate, it's always location.
Yeah.
In the stock market, we always hear it's buy low, sell high.
Yeah.
Is that true?
Well, of course it's true. And the problem is, how do you know when a stock is low and how do you know when it's high?
What's the answer to that?
Yeah, so, well, here's the problem with that. Everybody is looking to financial advisors to spray the Windex on your crystal ball and tell us what's going to happen. And we're looking at information that's helping us, but the truth of the matter is a stock. The easiest thing to do is, when do you buy a stock? That's the easiest thing to do. We can look at Home Depot and we can say, well, here's what their sales are. We know that in this economy that people are going to be doing a lot of fixing up. They're going to buy their stuff from Home Depot. We can get a good idea of the fundamentals of Home Depot, right? And we can decide, I want to buy this stock right here. That's the easy part. The hard part is when do you sell it? Let me give you an example. Let's say you paid $20 a share for XYZ stock, and it trades up just, let's say right away it trades up to $30 a share. NVIDIA, let's use NVIDIA, because I'm getting that phone call a lot. People are calling saying, what do you think I should do with NVIDIA? Well, if I had a crystal ball and I could spray Windex on it and clear it up, I could tell you. But if right now, do you think that I ought to sell it? Well, then you've got a lot of parameters that you've got to look at to say, okay, well, what if the stock goes higher? What if the stock goes lower? What about capital gains tax? You got all of those things, and all of a sudden, the person who owns the stock says, oh, gosh, I'm not sure what I ought to do right here.
I used to know a state senator from Rome, and his father was in the investment business. And he said, I will never get into it because I might as well just go to Las Vegas and play the casinos. How do you respond to something
Well,
like that?
I hear that a lot.
Do you?
I mean, you're taking a chance when you go to Las Vegas with owning a company. You've got some information that you can make your decisions on. When you go to Las Vegas, you're not investing in a card game. You're playing chance. When you invest in a business, you're owning that business, and so it'd be the same as this radio station. You are an investor. You own this radio station, and while it's not publicly traded, it's the same concept. We're all investing our money in ownership of something. That's a little bit different than gambling on the Falcons game.
Yeah, the way I respond to that is it owns me. So,
Well,
anyway.
Unfortunately, that's true also.
Now, okay, I'm going to challenge you here. Now, in the early part of this, you referenced inflation and all this money that's floating around the economy that we had from COVID, that we had from this administration, trillions and trillions of dollars. I think it's 7 or 8 trillion that has been pumped into the economy. Now, but this has an effect, does it not, on the price of stocks and on these indices?
Well, certainly it does. There's inflation is a really, really big subject. But to boil it down to this, some inflation is good. So, one of the things
well, how much?
Well,
I mean,
that depends.
When
That
Trump
depends.
left, it was 1.47.
To me, that was a good one.
Okay,
The Fed's number is 2%.
Okay.
And but then they take out food and energy. Okay,
Right.
so and that's the two biggest things that we use. But here's the thing: a certain amount of inflation is okay, and the question is, how is it that the market is going up when we're battling such inflation with interest rates going up? And it's because inflated numbers at our level are also inflated at the wholesale level. So companies they're charging more, so earnings are better, and stock price and people are putting their money still in the markets. So inflation is having an effect on where we are everywhere. Now, at some point, and we're probably already seeing this, inflation is really cutting into every single person's net worth, for lack of better words, just because it's costing more money to do everything we do right now.
Particularly food and energy.
Food, oh man,
It's crazy.
I went every time I go to the grocery store and get 3 items, it's $100.
Yeah, I mean, it's just nuts.
Yeah, I don't get it.
Yeah. Well, I don't think anybody else does. All right. Well, I'm gonna ask one more question, and we'll hit the commercial and come back because then I've got the surprise question for you.
Oh boy.
But you referenced interest rates, and we hear a lot about possible cuts of the interest rates. We hear a lot about the Fed, and the Fed was created under the Woodrow Wilson administration. I think it's 12 member banks or 11 or 12. We're really, in large part, at the mercy of them because they're not part of the federal government. Are we not to a degree, and not only affects mortgage rates and everything else, but also affects the markets? So what kind of effect through the remainder of the year, as everybody speculates whether we're going to have 1, 2, 3, or whatever, interest rate cuts, what do you see in that realm?
Well, that was a long question.
I know.
With a lot of moving parts.
Well,
let me answer what I think you're saying.
Okay.
To your point, yes, the Fed is not. It is not a
Government.
It's
entity.
not government agency. It's its own independent, and they do affect the direction of interest rates. They are an integral part of the markets. You'll remember this back in October. So 2023. So 2022 was a horrible year return wise. 23 was a good year, but the market had sold off in October. of 2023. And it was all because the market was hearing that the Fed is not going to lower rates. Matter of fact, they're going to raise rates. The the Chairman Powell came out and said, we think that we can start easing rates in 2024. Then all the pundits said, oh, they're going to cut 6 times. And the market exploded. We flew into the end of the year, beginning of the year, all the way to April, based on interest rate cuts. And then as the year continued along, what you started hearing was, well, it's not going to be 6 cuts, it's going to be 3. And then Powell would have his once a month or almost once every month Wednesday meeting, and well, here's what the data's saying, and then all the pundits come out and go, well, it's not 3 cuts, it's 2, and they started having bets in Las Vegas on how many cuts there was going to be. Well, now it's down to there's going to be 1 cut, and it's going to be in September. I don't know if they cut or not. I'm not sure I see how they're going to cut, because inflation, while it's not growing like it was, it is still growing. I don't know how they're going to pull that off.
Okay, one day we'll do a program on the Fed.
You could do the whole 30 minutes.
Yeah, and it won't be pretty.
And it won't be fun, and you won't have many listeners.
Yeah, I know, but it'll be a good thing to do. We're going to take a break. We'll be back with more with Dave Pollard, registered principal at Raymond James Investment Firm.
The AP Scholar Journey at Oak Mountain Academy is designed to provide students with a clearly defined advanced placement curriculum track to earn a series of distinctions upon graduation. This journey enables academically prepared students to pursue college-level studies throughout 17 AP courses in 5 subject categories while enrolled at OMA. I'm Patrick Uran, head of school, inviting you to journey with us on the mountain. For more information, visit us at oakmountain.us. Discover your journey at OMA. Prepare, explore, and achieve.
Health is a journey. It's making better choices, even when it's not easy. It's taking care of yourself and the people you love. At Tanner Health System, we're there for you with every step, with primary care, heart care, cancer care, women's care, orthopedics, surgical services, and so much more. We're dedicated to helping you live and feel your best. So let's get on that journey to health. You've got places to be for many years to come. Find us at tanner.org.
All right, welcome back. Dave Pollard's in the studio. He's delighted to find out we only have 8 minutes left. Anyway, all right, so I've got some more trick questions for you. This is a presidential year. And we always hear in a presidential year about an October surprise. And obviously the presidential politics now is somewhat upside down. And so I do have a serious question along that lines. And also I'll throw in, for the sake of time, we're operating a $36 trillion debt. We've got a $2 trillion deficit at the federal level. So my question is, what scenario is out there, if any, that you may see, or maybe you don't, that could really crash the market?
Well, I don't think a crash is coming. And I know that's contrary to every...
So you don't, the debt, unsettled geopolitical, none of these things combined could bring the market down significantly in your opinion?
Well, let's define a crash. Is a 30% pullback, is that a crash?
How much was it in 29? 30%?
Yeah. Well, I mean, is that a crash, or did we come back from it? I mean, a pullback, we came back from it. Right. 87, we came back from it. 94, we came back from it. 2001, we came back from it. 2020,
COVID.
2022, we came back from it. It's not a crash, it's a buying opportunity. You got to look at it as an opportunity to
buy
move
low,
into the
sell
market.
high.
Buy low, sell high. There you go.
That's fine. I love that answer. But the question is there anything on the horizon that you see that could make a pullback of the market?
You know, again, let's spray
particularly the debt.
The deficit. So let's spray the Windex on the crystal ball. There could be some stuff out there that we don't know about. The investment community we call it the black swan. The October surprise is for the elections. I don't know how more bizarre you can get in politics than what we're seeing right now. Now, in our history, we've had something similar.
Many times.
Yeah, but it just wasn't in our time.
Right,
we're getting to live it out,
times.
so it feels sort of weird.
So Black
it's bizarre.
Swan is a comparable to the market.
It could be the October surprise. A black swan in the investment lingo is the big event you just didn't see coming. That catches you by surprise. Now the deficit, it's massive, and it is daunting. We can't even fathom $35 trillion, right?
Right.
But we can fathom this: is that the person who is covered up in debt, credit card debt, mortgage debt, car debt, and that person, it looks like that they are bound for bankruptcy. Well, there's a couple things that person can do. Number one, let's say that they get a job where they make twice as much money or 3 times the amount of money that they're making now. Well, they can now service that debt and get out of it. It's sort of the same principle on the – you're shaking your head. Well, hold on a second. You can grow yourself out of this deficit, but we've got to get it under control.
Government itself cannot. Economy can grow itself out of it. Well, the government can't grow itself out of it.
Well, no, the economy can grow yourself out of it with your gross domestic product.
But government has the printing press.
That's right.
So,
but who's buying the bonds? We're getting back into the federal government. To the Fed governors.
When they stop buying the bonds, then what happens?
Well, when they stop buying the bonds, at some point it could all collapse and fall in on itself. But we've all got a vested interest. We will figure out how to get out of it.
I think the analogy with the individual or their business is over debt or has overriding debt, too much credit. Applies, but it only applies to a certain point.
Well, it does, but the federal government can tax, and they can bring it in other ways. Now, you need to understand, I'm not in favor of taxation.
Yeah,
I want to cut taxes the whole 9 yards.
I got it.
But you can grow yourself out of this deficit. Now, will we do that? Who knows? I don't know.
Okay.
Time will tell.
Fair enough. Now, you don't pick hot stocks. That's not what you do. So you can't say. You kind of referenced that earlier. You have other resources that does that for you, correct?
Well, we use money managers now. Where when we started in the business, you picked your own stocks, you charted your own stocks, you researched your own stocks. But now we use money managers to manage portfolios for us.
One good thing that we saw that we referenced in our last program, then we're going to have to wrap it up, is the central bank digital currency was outlawed in Georgia by the legislature. So kudos to them.
Right.
Okay, cool. If someone wants to learn more or begin investing, and how should they get in touch with Dave Pollard?
Well, you can reach us at 770-834-4455. That's the number to our office here in Carrollton. Or you can visit our website at raymondjames/financialpartners.com.
Well, thank you for coming in.
It's always a blast.
It's
pretty intense. It's a lot of fun.
Yeah, well, you haven't seen intense yet. The next time you come, I'll give you intense. But no, I appreciate the answers, and this is very important stuff for a multitude of reasons. Even if someone's not an investor.
Well, I appreciate you letting me come in. I always enjoy it.
Well, we'll probably let you come back. We'll have to think about it.
You're so sweet.
I know. All right. Thank you for listening. Go out and make it a great day. You're in tune to WLBB Carrollton.